what I wanted to do is start back here. And I should just look at my main screen here. Okay, so I want to start, and I'm going to keep us out of slide mode just so you can see some of the markings I've made on these slides, okay, about me having to write them back in. Okay, yeah, we talked about the big takeaway from the last, from chapter 4 here, was this audit risk model. Okay, and we say that audit risk, and of course, audit risk is the risk that we will give an incorrect opinion. We'll give, say, an unmodified, unqualified opinion, when in fact there was a material misstatement that we didn't detect somehow. And so we should have given a qualified or maybe even an adverse opinion. We gave an unmodified, unqualified opinion. So what happens? We have audit failure. So our audit risk is the risk that will give the incorrect opinion. And it's made up of these factors, which is our inherent risk, our control risk, and our detection risk. Remember, inherent risk is the risk that there'll be a misstatement in a particular assertion for an account balance, regardless of any internal control. So we say cash typically has a high inherent risk. I think we had the example of a jewelry store with diamonds and rings having high inherent risk. Okay, things that might have a lower inherent risk might be something like fixed assets, because they're much more difficult to steal when nobody's looking, right? So we have that inherent risk. We then have control risk. Control risk is the risk that the internal control will not prevent or detect the misstatement. So that really is depending on how good of a job management has done in instituting controls that will prevent, detect the misstatement. Then we have our detection risk, and detection risk is really the thing that the auditor can control, and that we will adjust that according to our assessment of our inherent risk and our control risk, which again is really making up the risk of material misstatement, that RMM. So we control our audit risk by controlling our detection risk. We do control our detection risk through our substantive testing. So in this particular case, since our risk of material misstatement was at the maximum, we went ahead and we lowered our detection risk to a low level by, and this is supposed to be a little teeter-totter here, by increasing our substantive testing. And when we say increasing our substantive testing, it's really just broader than saying doing a lot more testing. It involves, and a good way to remember this is by the mnemonic NET: nature, extent, timing of our substantive testing. Nature, meaning we want to use a more effective procedure. We're going to use external evidence instead of internal evidence for our substantive procedures. Extent, larger sample sizes. Timing, we'll do our testing at year end rather than at interim. And we're doing this with this little drawing down here because we have such poor internal controls. There's a hole in the roof being the internal controls. All the misstatements are raining down and hitting the financial statements. We're going to do our testing near year end to make sure that all those misstatements have hit the financial statements, throughout the year. We're doing our testing at year end, so we're catching all of those misstatements through our substantive testing. Substantive testing is sort of my little bucket. That's an ST down there. Substantive testing, that's the little bucket, catching, detecting all of those misstatements. Okay. Now, the alternative would be that our internal controls maybe are a little stronger. So in this example, I had better controls. I think in their jewelry shop, we had dual custody of the assets, that sort of thing. And so notice my internal control, my roof was a little bit stronger now, okay? And so what's happening? It's preventing all those misstatements, that rain, from hitting the financial statements. So when I have better controls, I can accept, and guys, never say a high detection risk. You don't want a high detection risk. It is simply higher than the previous slide. Notice from a numerical standpoint, it has gone from 0.05 up a little bit to 0.10. So to keep my audit risk at 0.05 still low, I can accept a little more detection risk because my risk of material misstatement has come down because of the fact that I have these better internal controls. My control risk now, instead of being at the maximum, is at moderate. And so what happens? Now, when we look at the nature, extent, and timing of my substantive procedures, I'm going to see that the teeter-totter has come down. Nature, I can use a less effective procedure. For example, I can use internal evidence instead of external evidence for my substantive procedures. Extent, smaller sample sizes for my substantive procedures. Timing, now I can do those tests at interim rather than year end. So maybe I'm doing my testing at 9:30, the bulk of my testing, and instead of having to wait till year end. Now, that doesn't mean that you just ignore, or say the back quarter of the year, assuming the 12/31 year end here. I would still do some sort of roll forward procedure to make sure that I believe that the financial statements didn't go to hell in a handbasket to the back end of the year. So I would do some amount of substantive testing there year end. Review. Comparing last year's fourth quarter to this year's fourth quarter. Or maybe I say, well, look, if my detailed testing constituted the first 3 quarters of the year, my analytical review procedure my analytical review procedure would be to see that the last quarter was, was 1/4 of the entire year and constituted the 1/4 of the entire year. That, of course, assumes there's no seasonal variation in whatever I'm looking at, revenues, expenses, whatever it is. Okay. Any question on that? Okay, good. Now, if I want to sit there and look to see that the internal controls, if I've liked the design and the control has been implemented, then I have to test operating effectiveness. I literally have to have evidence that supports that lower assessed level of control risk. So I will have to do some measure of internal control testing at that point in time to see if the controls have operating effectiveness. So that takes me back up a little bit to these couple of slides, and those basically 4 slides, the 2 I'm going to show you and the 2 I just showed you, really work together. Okay, so let's just put the key words onto that assessment process that I just talked about on those previous 2 slides. So what happens in the obtaining the understanding phase? That's a key term you need to know. Obtaining the understanding phase, I do what? I am going to look at the inherent risk. I'm going to understand the environment of the entity, and I'm going to look at the controls to see if they have an adequate design and if they have been implemented. So I look at the design, I look at implementation, and based on that, that's how I make that assessment of the risk and material misstatement. I'm looking at the entity, its environment, I'm looking at the particular account to see what sort of inherent risk it has. I'm understanding the controls. And we're going to talk about how to understand the controls here in a little while, but I'm going to get an understanding of those controls to allow me to assess the design. And then I'll probably do something called a walkthrough, which is a 1-day procedure where I walk through transactions to see if the controls have been implemented the way they've been described to me through my inquiry of management and whatnot. If I believe that the controls have been implemented, I'm satisfied with the design, I will assess the risk and material misstatement. Remember, inherent risk, control risk together constitute the risk and material misstatement. And so I will then assess that at less than the maximum if I like the design and it's been implemented. If I assess it less than the maximum, then I have to follow that black arrow, and you can see on the next slide that I will first, and that's when I need to test those controls, I will test the operating effectiveness of the controls. So I will probably pull a sample of transactions to look to see if the control was applied. If there's some sort of inventory that's done on a daily basis, I might pull a sample of 50 days worth of transactions and look to see that they were signed off on. Remember that if I do a walkthrough of 1 day, then I would only have to look at 49 more days worth of transactions to see that there was some sort of sign off, whatever it is I'm looking for that control. And then I still have to do some level of substantive testing. You always do some level of substantive testing. So nature, now I could probably use internal evidence for my substantive test instead of external. Extent, smaller sample sizes, timing, doing some sort of interim testing, although I still would need to do the roll forward to the year end. If I'm looking and I have assessed the risk material statement at the maximum, because I don't like the design, or I don't like the implementation of the control, I don't believe the control has been implemented, I assess the risk of material misstatement at the maximum. I follow the red arrow, and there is no requirement for me to then test the operating effectiveness of the controls. I will go directly to my substantive testing, but now to lower my detection risk, I'm going to have to do my substantive testing at year end, matrix and timings. Choose the mnemonic nature. I'm going to have to use external evidence instead of internal evidence. Extent, larger sample sizes, timing. Now I'm going to have to do year end testing instead of interim testing. Okay, so these two slides really work together. Okay, these two and these two. Okay, any question on that? Okay, remember when we talk about our detection risk, there are sampling risk factors associated with detection. Let me go back. Let me point out something. Notice the audit risk formula. Nothing is zero. There is no such thing as a zero inherent risk, a zero control risk, a zero detection risk. There's always some risk associated with each one. So there's no zeros, so you never have audit risk at zero. That's why we say we give reasonable assurance, not absolute. There's always some chance. We try to keep it low, but there's always some chance that we will give the incorrect opinion. We'll have an audit failure. We'll give a unmodified, unqualified opinion when we should have qualified, should have adverse, whatever, should have disclaimed, okay? Now, we will never get that to zero, including our detection risk. And so when we look at our detection risk, we can break that detection risk into two components. Those associated with sampling. What happens? We're not going to look at every single transaction. We're generally not going to look at every single transaction. You audit McDonald's, you've seen the signs, billions and billions. How are you possibly going to audit every single transaction? So you'll pull a sample. There's always a chance that your sample will not be representative of the population. Okay, so that's going to create a detection risk because our substantive procedure isn't applied on everything. So there's a chance that our sample will indicate something different than the actual population. That's part of our detection risk. The other part of our detection risk is not related to sampling. We call them non-sampling risk. This comes up because we're not perfect. We're human. We could make a mistake when we apply the audit procedure. Okay. Perhaps we have a situation, we're going to talk about fraud here a little bit. There's a situation where management is intentionally concealing misstatements from us, et cetera. And we are not here to say, hey, we're going to always be slicker than the person that's concealing, misstatements from us as fraudulent. They could be a little slicker than us, and we're not a guarantor of detecting fraud. We'll have to consider fraud, but it's not something that we can guarantee against. Okay. Any question on any of that, guys? Okay, good. Now that's an overview of what we talked about last time, but I'll put on that. That's an important overview. I mean, that is going to be a theme that is going to be central to the exam. I'm not going to go back through those questions because we covered them last time. My recollection is that we had stopped right here. So if there's no questions about what we kind of key elements from last time, I'm going to go ahead and jump into some new material here. Okay, well, we kind of started this last time, but let's just go ahead and jump in to our risk assessment. And when we make our assessment, again, we are assessing the risk of material misstatement. We assess it at two levels, and we have two responses to that, two levels of response to that. Okay, so first we will have response at the financial statement level. Okay, and now response to the financial statement level is going to dictate how we are going to assign staff to the engagement, et cetera. Okay, so there's a high level financial statement level assessment of our risk, but then we're going to have to assess the risk of material misstatement at the assertion level. And when we do that, we're literally going to take our account balances and break them up into assertions and assess the risk by assertion. And then we're going to respond, understanding how the internal controls would prevent or detect the misstatement in the assertion. If we think the controls have proper design and are implemented to prevent or detect the misstatement in the assertions, then we will go ahead and test the operating effectiveness of those controls and move over to our nature, extent, and timing of our substantive procedure. If we assess the risk of material misstatement for a particular assertion at the maximum, we won't test the internal controls associated with that particular assertion, because again, you don't have to test ineffective controls, but then the nature, extent, and timing of my substantive procedure is going to be such so that I lower my detection risk using what external evidence instead of internal, doing my larger sample sizes, timing, doing year-end testing instead of interim. Okay, so what we're going to do is we're going to look at how do I respond at a financial statement level, how do I respond at an assertion level. So let's take a look at, before we jump into the next slide, let me ask a question. We're going to talk about financial statement level risk, so get ready, okay? Who wants to be the partner in charge of this engagement right now? Get ready to do an engagement. I'm looking for someone that wants to be the partner in charge of this engagement. Probably said this before, but I'm going to repeat while someone's getting up the nerve to the courage to be the one that's going to become partner here. Okay. Let's say, oh, no, so let's say, I'm going to give you that example in a minute. But when you look at understanding auditing, you understand it from the standpoint of a partner in charge of the engagement. Okay, the standards and things that we're talking to you about are decisions that partners make, those in charge of the engagement make. And sometimes I think students have a little bit of trouble with that because especially some of my students that maybe have experience in auditing, they say, well, I wouldn't decide this. This is a decision that's made by my partner. So why do I need to do this? I'm just learning now. Well, the way the standards speak to, they don't speak to a first-year staff, they're speaking to a partner. Okay, so you need to understand, even though no one's going to trust you on your first audit to make these decisions, you need to understand the nature of the types of decisions that should be being made by partner to properly design the audit, okay, properly carry out the audit. So with all that, who wants to be the partner that's going to make decisions based on financial statement level risks?
I can do it.
Okay, who's that?
Davi.
Okay, thanks, Davi. Okay, ready? So you're now partner, so congratulations. Okay, you're the partner on the engagement. All right, and let me ask you, you have a client in which I'm thinking there is a high risk of material misstatement for the financial statement. So we've looked at the inherent risk, we've looked at the controls, we've assessed those risks at maximum. So are you going to assign a more senior manager to this engagement or a less senior manager?
I would say more senior, because high level of misstatement, and you want to be able to, you want to have someone experienced enough to catch everything.
Right. Okay, good. How about management style? You're looking for somebody that's maybe a little more aggressive in their management style, maybe a little more lax.
Aggressive.
Okay, good. Very good. All right. How about supervision, Davi? Are you going to visit that audit site more, or are you going to maybe just let the team do their thing?
Yes, I'm going to be more hands-on.
Okay, good. Excellent. So what you just made are a couple of the important decisions that would be made when you have at the financial statement level responding to that risk. So if you have if you have higher level risk, assign more experienced staff, you're going to carry out more supervision, right? Okay, so you take a look, and this is probably the better slide as to how you would respond. It's a little more complete. You're going to communicate the team to the team, increased need for, remember we talked about professional skepticism, right? That's a mindset that we have in the audit. Assign more experienced staff, increase the level of supervision, right? So it looks like I picked the right person for a partner, right? Very good. Okay. All right, good. Now you come over and you take a look, and of course we have what? Our assertion level risk. Okay, now the first thing we need to understand is, well, what's an assertion? Okay, what are we talking about here? What assertions are we going to be considering? But then we will look at what is the potential misstatement in that assertion? What could go wrong? Okay, we're interested in what could be the misstatement in the financial statements. So are they going to put down an asset that doesn't exist, etc.? That is the assertion that we're going to be concerned about, and then we'll design our audit procedures accordingly. And when we say design our audit procedures accordingly, we will assess the risk and material statement by looking at our inherent risk, looking at our control risk, understanding the design and the implementation of the controls. And then depending on our assessment of risk and material misstatement, we will respond by potentially testing effective controls and then going from there with our substantive procedure. Or if we've assessed the risk and material misstatement to maximum, bypassing the testing of the operating effectiveness and going straight to our substantive procedures and doing the full measure of substantive procedures. Okay, so that's where we're going when we consider assertions. Now, it is important that we know what our assertions are. Okay, now, from now on, we're going to think of financial statements as assertions. Okay, and this isn't critical. This is probably the most important thing you take away from this class is that when you look at a set of financial statements, you don't look at them in terms of numbers on account balances. You look at them in terms of assertions. So management is asserting to you that assets exist, that liabilities are complete. Okay, so that's how we're going to look at financial statements in terms of assertions from now on. And when we look at the assertions, we break them basically into three categories: transactions and events set of assertions, account balance set of assertions, and presentation and disclosure set of assertions. Now, when we look at transactions and events, I want you to think of journals. I want you to think of journals, and I want you to think of the current, that says current year transactions. So when we're talking about transaction events, we're talking about journals, we're talking about current year transactions. Okay. When we talk about account balances, I want you to think of your ledgers. Not legs, but ledgers. Okay, and that is all years. Now, when I say ledgers, I think everybody's favorite ledger is the general ledger. Okay, so what do you have? You have sales journals, you have general journals that record transaction chronologically year to year, but then of course those get posted to your ledgers. And I say all years, and what? We bought a piece of equipment 2 years ago. Of course, we would have recorded in our purchases journal or something in the year that we acquired it, but then that would have gotten posted to our ledger. And assuming we haven't gotten rid of that equipment, it should still be sitting in our ledgers, say 2 years later, assuming we haven't disposed of that equipment. Okay. When we talk about presentation and disclosure, we're talking about footnotes. Okay, so when we look at these categories, then we have relevant assertions that fall into these categories. Okay, so the assertions include completeness, cutoff, accuracy, classification, and occurrence for our transactions. For our account balances, it includes completeness, allocation, existence, rights and obligations, and valuation. For our presentation disclosure, we include completeness, understandability, classification, rights and obligations, valuation, and accuracy. Okay, now let's just think about these transactions for a second, or these, excuse me, these assertions. In fact, let's just go over, well, let's talk about it here, okay? And then we'll go over and look at them on the next slide as well. But let's just go ahead and look at them right here. So, completeness. Let's start with this one right here under transactions and events, completeness. So I want to make sure that all transactions that should have been recorded during the year, right? Because we're in the transaction events for the current year, were actually recorded. I don't want management to, and I'm going to put quotes up accidentally because we're going to talk about fraud a little bit later here, and it could be intentional, but I'll go ahead and give them the benefit of the doubt, say it's an error. I don't want management to accidentally forget to record a transaction during the year. So what I'm going to do is I'm going to take completeness as an assertion. I'm going to look for internal controls that would prevent or detect them making that mistake, that potential mistake, and making that thing that went wrong. They accidentally forget to record a transaction. If I like the controls that are supposed to prevent or detect, when I say like, I like the design, I like the implementation. I will then test the operating effectiveness of those controls and then design audit procedures now around the completeness assertion. So I design my audit procedures for that assertion to help prevent or detect a misstatement in that particular assertion, in this particular example, completeness. Okay. Now the other assertion here that I want to talk a little bit about is occurrence. When I look at occurrence, I'm going to sit here and I'm going to say, well, look, if a transaction is recorded in the journals, did it actually occur? Did it really happen? Maybe management is putting down a sale that never took place because they want to increase their sales. So I will look for, again, internal controls that will prevent or detect that misstatement in the completeness assertion. And then I'm going to design audit procedures around the occurrence assertion. Okay. What else? Cutoff. Cutoff says that they've recorded the transaction in the proper year. So what happens? They get to close to year end, when we get close to year end, and potentially they, again, I'm going to do the annoying quotes I forgot, recorded the transaction, or not forgot by accidentally, recorded a transaction that should have been recorded in 2020, and they don't get around recording it until 2021. So for my cutoff procedures, I'm going to, again, look for controls that prevent or detect that, but I'm going to design my procedures close to year end. Okay, what else? We have the classification. Okay, did they record it in the correct account balance? Okay, is it accurate? Are they using the right dollar amounts for the transactions? Okay, now you look at account balance and notice you have completeness again. And you say, well, John, why would completeness be in both cases? Well, we want our journals for the current year to be complete, but we also want what? Maybe they borrowed some money 2 years ago and they haven't paid it back. That borrowing wouldn't have been recorded in the current year, but there should still be a balance properly reported for that liability. So we would design procedures around completeness. Okay, what else? Existence. Even though they bought the asset 2 years ago, if they're reporting it in the financial statements, it should still be there. We should still be able to go and potentially look at that asset. Okay, regardless of when they acquired it, it should be valued correctly. So now we're maybe more interested in, hey, you know, we've satisfied that they have an account receivable, but have they put in enough an allowance for the potential that they won't be able to collect on that receivable? Okay, you take a look, rights and obligations. Well, okay, they're carrying an asset on their books, but have they pledged it as collateral against some sort of loan? If they have, then we're going to want to make sure that they have made the proper, and that takes us to disclosures around that. Notice rights and obligations are down here in the disclosure discussion, because if you've done something like pledged as collateral, your inventory or something, that should be properly disclosed in the footnotes. Notice also, we want to make sure they have complete set of footnotes. The footnotes are understandable, meaning that they have to be written well. That's why here at Golden Gate, we make you take communication, accounting communications, because you need to look to make sure that you're satisfied that there's been proper communication in the footnotes, the financial statements. Valuation, what happens? Even though I carry an asset at historical cost, there could be a requirement that I have to give some sort of fair value associated with that. Okay, so when you look at these, I know it's a lot of information on one slide, and you're kind of like, huh, you know, how am I supposed to take all this in? Right now, I'm just wanting you to start to get a notion of how we design our audit procedures around assertions. We look for the internal control to prevent or detect that. We potentially would test those controls. We design our procedures around the assertions. Okay, that's the key thing right now. And then you're going to keep this discussion in mind so that as we go through the account balances, as we move forward in the class now, when we look at a particular account, it's not memorizing a bunch of procedures that relate to that account. It's understanding how to audit these assertions. Okay, so let me stop there for a second and just see if there's any, I don't know, maybe you're panicking at this point and want me to say something to make you feel better, because I know this is a lot right here on this particular slide. No? Okay, good. And let's go ahead. I'll come back to this one. I want to go ahead and just look right here. Okay, and let's talk about probably the two key assertions in the financial statements, okay, which is existence and completeness. Okay, existence and completeness. Let me just underscore, it's probably easier to underscore. Existence and completeness. Okay, so they have on this slide the words vouch and trace. Okay, we vouch for existence, we trace for completeness. Now what happens? I put this slide up and then I can hear the wheels turning in my students' heads saying, okay, vouch for existence, trace for completeness. That's the most important thing on this slide. And I'm here to tell you guys that on your first day of auditing, people will use trace and vouch interchangeably, and they don't really remember what it means. And you don't want to be the one sitting there saying, excuse me, you said vouch and it looks like an existence. It looks like a completeness procedure for me. You just said trace, and I think we're doing existence. Nobody talks this way, the way you see on this slide, okay? But the most important thing, I'm not going to sit here and test you on, hey, do you know that vouch is for existence and traces for completeness? I want you to understand the logic here, okay? So what happens? If this is the financial statements, okay, and I have my supporting document over here, just put support, what's happening? I'm going from the financial statements. So I'm going to say the general ledger. Remember we said the ledger? Okay, I'm going from the general ledger and I'm going and I'm selecting a particular asset, say a piece of equipment, say it says here robot. Okay, I'm gonna use my little robot here again. That's on the financial statement. It says they have a robot. So what am I going to do? I'm going to go and I'm going to try to find the robot. The general ledger says, or the subsidiary ledger says robot 123. I go out and I walk the floor of the company and I try to find that asset. Here it is. I found robot. Yep, that's 123. I checked the security code on it, whatever, the little label they put on there. I check that. It matches up to the financial records. I just tested the existence assertion by doing what? Going from the financial statements to the supporting documentation. Okay. Now, if I want to do completeness, now, so that was existence. Let me write existence there. Okay.
Right. Did you physically find the robot, or you found documents that prove that the robot does exist, or both?
You could do a document if it wasn't something that you could go physically touch, okay? But in the case of equipment, the common procedure is to actually go and find that piece of equipment, okay? Because why not? The auditor's direct personal knowledge is the most convincing form of evidence. And so if I go and I find this robot, right? Then I'm sitting there and I'm like, okay, there is no better evidence. I could look at a piece of document that says they bought the robot. In fact, I probably would apply the procedure of looking at the document that says, okay, they bought this robot on such and such a day, because that is helping me with the rights and obligations assertion. Remember, it's not just under, and we would probably be under account balance here. It's not just the existence, what we've proved by finding the thing, but it's also rights and obligations. I want to see something that proves that they bought this thing, that they actually purchased it. So different assertion, different audit procedure. For the existence assertion, the audit procedure is, hey, go find that robot, go find robot and check the inventory tag. Boom, I did that. Get the invoice. For valuation, not valuation, excuse me, rights and obligations, go find the invoice that says that they actually bought it. Okay, they bought this, because for all I know, they're renting this robot. And if that's the case, then they don't have the rights and obligations to it. They probably gonna have to take that off of the financial statement because they don't actually own it, they're just renting it, right? Valuation, okay? Yeah, okay, this is a nice, handsome looking robot, but does it actually, work? So I might do something to see if it works. It looks like my robot's dead. No, it's okay. Okay, so I said, all right, the thing works, so it's properly valued. Okay, so I would go through different procedures, check the, look for signs of obsolescence, whatever. And so I would do a set of procedures around the valuation. So for each assertion, you do a different procedure. So Davi, I guess what I'm saying here, if it's the existence assertion, the support would probably be actually looking to find that particular item in the financial statements, if I can physically look at that thing. But if we were talking about a different assertion, which isn't shown on the slide, say rights and obligations, then I'm looking to see the invoice.
Okay, thank you.
Okay, now, if we're talking completeness now, then what? Then for completeness, we're going to go from the support and take it back to, and I shouldn't probably draw my arrow there. I want to draw it here. Take it back to the financial statements. Okay, so now what am I doing? Now I'm sitting there and I'm saying, okay, priceless statue. Okay, now what happens? My friend's daughter painted this for me, because I told him that I had an uncle who used to box, so this is supposed to be my uncle who used to be a boxer or whatever. They painted this for me, this Cuban and Puerto Rican, since I'm Cuban and Puerto Rican, they made this for me. But anyway, so what happens? I find the asset. In this case now, it's this little statue, whatever, right? I find the asset and I do what? I see, okay, here's this asset. And then I look in the financial statement to see that they properly reported this statute. So now what? Now by doing a set of procedures where I'm finding the asset, I'm finding the various assets, whatever they are, and I'm taking them back to the financial statement, that is the completeness assertion. Okay, so we are going to look at procedures and we're going to look at them as they relate to accounts. But at the end of the day, we're going to look at the accounts, but we're going to really be understanding financial statement assertions. Okay, so what I want to do with this one, if I can somehow create a new whiteboard here. I don't want all that nonsense. 1 second, guys, I gotta get rid of this stuff. Okay. All right. So what I'm going to do is give you an example here. And let's see. I have my general ledger. Okay. Feeding into my general ledger, I have my subsidiary ledgers. Okay, now that's a subsidiary ledger. Now, subsidiary ledgers, as you know, contain the detail, right? So general ledger will say account balance for equipment is 10 million, but then the subsidiary ledger would list what? Would list, you know, a robot, statue, et cetera, and list all the different, all the different assets that make up the total for the equipment, okay? Then I would have here feeding in to my subsidiary ledger, I'll have my journals, okay? And for this little example, I'm going to use sales. I'm going to make it my sales journal. Everybody's favorite journal is sales journal, right? Okay, so I'm gonna have my journals, but I'll say my sales journals, okay? And then I'm going to have supporting documents. So, well, in my sales journal, let's say I have sale. Well, I'll put not sale, but I'll put invoice. Yeah. Invoice 1 for 100,000. I don't know, just making these numbers up here, obviously. Invoice 2, 200,000. Invoice. I re-spell invoice. 3, 300,000. And then I'll have invoice. Guys, I'm not going to sit here and write 17 numbers, okay? Invoice 17, okay? Just imagine there's other ones in there. Invoice 17, and we'll make that 2 million. Okay, all right, good. Now, this is what's recorded in the sales journal, okay? Now, my testing is probably going to start here. Okay, so even though the GL, of course, better feed into the financial statements, okay, GL feeds into the financial statements, okay? The general ledger then what feeds in the financial statements, subsidiary ledger feeds into the GL, and then the journals should feed into my level of detail here at the subsidiary ledger. And so what the auditor would do is do an initial procedure to make sure that this stuff up here all matches, okay? That if they're saying $10 million for assets, there better be an account balance in the general ledger that says $10 million. What happens if this first part right up here doesn't match? Let's say I look at the financial statement, it says $10 million. I look at the general ledger says assets 50 million. What should I do at that point? What would you do if you went into a client and let's say the sales in the general ledger said $10 million, and when you looked at the income statement said $50 million in sales? What would you do? Financial statement says sales 10 million. You look at the GL, and the GL has an account called sales that says $2. What would you do?
Well, you would look at that subsidiary ledger and try to see what happened.
Subsidiary ledger also says 2 million.
Then ask management, I guess.
Yeah, I mean, at this point right now, I'm going to management and say, what are you doing to me? I can't audit this. If you're telling me that you think the income statement is fairly stated showing sales of 2 million and you've got a GL that you're handing me right now that only says $2 million or $2, whatever, for the sales, I can't even start the audit. So the first thing I'm going to do is reconcile the financial statements to the general ledger to the subsidiary ledger to make sure I'm not dealing with a management that has lost their mind. If they can't even hand me a set of accounting records, when I say accounting records, the financial statements matching the GL and the subsidiary ledger, we're done. We don't have an audit at that point, because what I'm going to do is reconcile all of this, and then it's going to put me in a point where I can now start to audit these transactions that are sitting here in this sales journal. If the initial things don't match up, I don't even have a procedure that I can apply. What am I auditing? Yes, my opinion is going to be on these financial statements, but I at least have to have an accounting system that allows me to even be able to audit this client. So I would go ahead and reconcile the financial statements to the GL to the subsidiary ledgers, but that's sort of a cover your what step at the very beginning of the engagement to make sure that I just don't have some sort of crazy set of accounting records. Once I do that, then I can go ahead and start to apply my testing here, probably dealing with the journal level to go ahead and audit now the transactions that are included in the sales journal. Question? Okay, so the reconciling between the financial statements, GL, subsidiary ledger, basic step. Now I know that this is all lined up. Now I'm going to try to audit these entries in the sales journal. Okay, so let's say I have some supporting docs over here. And down here, I have the actual physical invoice. Okay. So I have the actual invoice here. And so I'm going to pull that invoice, but I'm also going to look for shipping documents. Okay. And so I find shipping document number 1. I'll put sales invoice 17 here. I find shipping document number 17. Okay, so I come over here and I find the invoice. I see that they say invoice 1 here for 100,000. I go down here, I see that they recorded that 100,000. I find that invoice number 1. I find shipping document number 1. So it looks like they shipped that document, and I look at the date that they shipped it to make sure they shipped it, say, before year end. And I look and I've satisfied myself with the invoice for 100,000. They shipped the sale, they shipped those goods within the year before December 31st, whatever. So it's got the proper cutoff. And so I'm now happy. What assertion did I just test? If I started here. I start with invoice 1, and I went and found the invoice, and I found shipping document 1. What assertion did I just test? I picked up the invoice that was sitting in the journal, and I went and found the supporting document for it and saw that that thing got shipped.
Oh, completeness.
Existence.
Okay, we got 1 vote for existence, 1 vote for completeness. Let's do the poll, why not? So how about A is going to be existence and B will be completeness. A is existence, B is completeness. Okay. Okay, looks like everyone probably voted except for me. I think I'm listed here as a participant. Okay, so I'm going to go ahead and end the poll and share the results. Okay, and most of us got it right. Okay, that's good. Okay, that's about a 70%. Now, the answer here is obviously, if I said most of us got it right, you can see the results. The answer here is
Both?
no, it's not both.
Okay.
No, there's only one right answer. The answer here is the existence. Okay, it's existence. Why is it existence? Let me go ahead and write that in, existence. What happened? I saw a invoice that was recorded in the sales journal. And for all I know, management just wrote that in, 100,000, whatever, okay? And they didn't actually, let me stop sharing the results. Sorry, guys. Okay, and they didn't actually have a sale. So they just wrote in 100,000. So if it didn't actually exist, what would happen? Well, I would go down and I'd say, well, okay, I see the invoice, but where's the shipping document? I would be able to prove that that transaction did not exist by starting from the financial statement. When I say starting from the financial statement, again, we reconcile the financial statement, the general ledger, the subsidiary ledger, but we'll really start our auditing procedures at the journal level, right? Where they've actually recorded these transactions that feed into these other documents, the subsidiary ledger, the GL, the financial statements, whatever. And so I'm sitting here and I'm pulling that transaction saying, hey, is there any sort of evidence that shows that that transaction actually existed, occurred during this year? Okay, take a look at this next one. Let's just do invoice number 2. Again, I want to see if it exists. So I start from the financial statement, from the journals, and I go over and I try to find the support. And I come down and I see invoice 2. But now when I look for what? When I look for shipping document 2, it's not there. I have shipping document 1. I don't have shipping document 2. What happened? So I go back to management. I say, management, look, we see that you recorded this sale, this invoice to you for 200,000. We could find the invoice, but when we looked for shipping document, we couldn't find any evidence that you shipped it. Did you actually ship that? And they say, oh yeah, thanks, auditor. You know, that was Bob. He used to do that all the time. We let him go. He used to make that mistake all the time. Thanks for catching that. Now what's happening? My professional skepticism buzzers are going off in my head at this point because maybe it was an accident. Maybe it was this Bob that did this, but maybe they're doing this intentionally to overstate the sales. So I don't just assume that it was an error. My professional skepticism requires me to consider that it could be fraud. Okay, but notice I found the misstatement in existence by what? Starting from the financial statement and trying to find the supporting documentation and go along with that. So when you start from the financial and you come over like we did with invoice 1, that one worked. We tested existence. When we started with invoice 2 at the financial statement level and went financial statement support, the journals that feed into the financial statements, when I looked for the supporting documents, I couldn't find the shipping document, and I found through further inquiry and whatnot that transaction did not exist. Question?
Professor,
Uh-huh.
can you give us an example of when it's completed?
Witness? Yeah, I'll do that right now. Okay. So now I go and notice I find this shipping document number 17 over here. Okay, shipping document 17. I find, and now I'm going to start over here. So I start over here and I find shipping document 17. I find invoice 17. I go back to the financial statement and I find invoice number 17. So now I just supported what? Completeness, because I found the supporting documentation and looked back and saw that it was in the financial statements. Let's say, and this thing's getting a little messy up here, but let's say I looked and I saw invoice 22. I'm just making these numbers up. I found shipping document 22. I start here, I find my documentation and I take it back. And when I look, 22 is not listed. And I say, excuse me, management, this document says that you had a sale for this item number 22, say $10 million. You have a sale of $10 million. It shows that you shipped this stuff. You charged the customer $10 million. But when I tried to find it in the sales journal, it wasn't there. The sales journal was not complete. And I found that by what? Starting from the support and trying to take that back to the financial statements. So I just disproved I proved that they have a problem with the completeness assertion for at least this invoice number 22, whatever it is. So I asked them, well, how come? And they say, oh, that was Bob. Bob used to make that mistake all the time. He'd have a sale and he wouldn't record it. We let him go. Now my professional skepticism buzzer is going off. And I'm thinking, why would they do this? Why would they intentionally understate their sales? Anyone got a reason? I mean, I could see the motivation to overstate the sales for the existence assertion to try to put down a sale that didn't happen. But why would they intentionally not put down a sale that did happen? Make their sales intentionally understated, intentionally incomplete. Why would they do that?
Mixed taxes, maybe?
Could be that they would understate the sale so they could pay less tax.
Misappropriation of assets. Someone stole it.
Could be that maybe the employees are shipping stuff to themselves and then not recording it in the financial statement. The only problem I have there is, well, generally when someone does something like that, they don't record anything at all. They're not going to leave a paper trail, right? Of, okay, here's the stuff that I stole. Okay, so generally they just steal the thing and there wouldn't be a paper trail. I'm thinking maybe, again, this is just art here, guys, more than science, okay? Maybe they have enough sales this year and they're thinking, hey, push that number 22, don't record it. Maybe the auditor won't catch that we didn't record it. And if he doesn't catch that we didn't record it, he or she doesn't catch that, we'll be able to include that as a sale into next year. That's a nice $10 million start into next year because we've already met our profit goals for this year. So there could be fraudulent motivations behind this completeness assertion for this one as well. Only thing you should really be taking away from this discussion right now is that the auditor always needs to maintain that professional skepticism. When you find a misstatement, you do not automatically assume that it is unintentional. It could be what intentional, it could be fraud. And we're going to see that fraud is more, the consideration of fraud starts to become a certain mindset that we're going to have to make sure our engagement team has. Okay. So again, take away from this. Okay. Try to start to get a flavor for the existence completeness assertion, because those are key assertions that a lot of times coming out of an auditing class like this, there's going to be an expectation that you really understand how to at least audit these couple of assertions. Now we will go and we will start to understand the various assertions as they relate to account balances as we go through the further chapters, but you are now assertion, misstatement and assertion hunting animals. Okay, you're looking for misstatement in the financial statement assertion. That's how we look at financial statements. It's no more, oh, this is cash. It's if they're reporting cash in the financial statements, did it exist? How do I see that something existed? I'm going to pull something from the financial statements and go find the supporting documentation that exists. Okay, Completeness. How am I going to make sure that they have everything that's supposed to report on the financial statements? Did they borrow some money and not record it on the financial statements? How am I going to do that? Well, I'm going to start with the support, and I'm going to see that it was properly reported in the financial statements, or look for something outside of the financial statements to see that it was properly recorded. Okay. Now, of these two assertions that we've talked about right here, which one is more scary to you? Existence or completeness? When I say scary, from the standpoint of one of these contributing to your risk and material misstatement.
Existence.
Okay. Why is existence more scary?
Because with completeness, you have evidence of something, and if it doesn't show up in the subsidiary ledgers or the general ledger, then that's proof that there's a misstatement. But if you're just looking for something, what if you don't find it, but it really does exist?
Okay, well, let's go back to our robot example. Okay. And let's say that I see the robot listed and I go to try to find it and I can't find it. What am I going to do? They say robot, and I go and I try to find the robot, and now pretend this time there's no robot here. Where is it? What am I going to do?
I think you'd ask the management, and if they don't have it, you'd ask them to take it off the financial statements.
Okay, so that would have helped me with the existence. I asked them to take it off, right? So if I can't find it, then I take it off the financial statements. It doesn't exist, right? I ask them. I ask management to make an adjustment, credit the asset account and debit loss or something or whatever, but get that off the financial statements, right? It's not here anymore. Okay. Now, completeness. You look around the whole room here. Anything in this room potentially should be reported on these financial statements. How scary is that? I obviously can't test everything in this room. I'll be here the rest of my life, or the whole world. It doesn't have to be in this room. There could be something out there that they borrowed money a long time ago that has to hit these financial statements in order for the financial statements to be complete. That is much more scary of a proposition to me, because I don't know what could be out there. There's a whole world that has to potentially be reported on this little financial statement, and I've got to try to design procedures that will help me to make sure that everything is reported on these financial statements. So completeness is the harder assertion to audit between existence and completeness. Completeness is by far harder because it's the whole room. It's the whole world that potentially should be reported on these financial statements that I've got to get my arms around some procedures that will satisfy me that we have complete information on these financials. Now, one of the best ways that we cover ourselves for completeness is at the end of the audit. We'll talk about this much later in the class. We have something called the management representation letter. And in the management representation letter, we make them, they speak to completeness in that letter. You have given us complete information. We make them sign off on that so that they're on the hook to understand that they were to give us a complete set of records that would allow us to identify if a particular item should have been recorded in the financial statements and was not. Question on that? Okay, again, a lot of information. The two takeaways right now, the couple takeaways right now is not to turn you into automatically being able to audit existence and completeness. We're going to get to that as we get to the various accounts. But I want, after the first midterm, but I want you to understand at this point, I just have to close this or at least lower it. And I just want you to understand at this point that we have what? We have our assertions, we design our audit procedures around those assertions. The assertions fall into 3 categories: transactions, events, account balance, presentation, and disclosure. Okay. Now, these are the assertions that are called out by the AICPA. These are the assertions that you would consider if you are auditing non-public. We consider them like this in these 3 categories, etc. The PCAOB has decided, first of all, not to group the assertions into the categories that we talked about, and they have slightly different assertions. For example, notice that the AICPA does not, AICPA does, I should say, call out cutoff, okay? And so they sit here and they have cutoff here, okay? Completeness, valuation, allocation, accuracy. So just some slightly different ways of looking at these, but very, very similar. Okay, so not a big deal between the two types. Main thing is they're not listed into categories here. Okay, we talked about how to consider these here on this slide, and I gave you the example on the whiteboard a minute ago. Okay, now this slide is very helpful in that it lists the assertions. You see the assertions listed here, and then we have auditing procedures that would go along with these assertions, because remember, our audit procedures go by assertions. So notice for completeness, we say here, start from the source document and look to see that they were recorded, ultimately recorded in the financial statements. Okay, so that's what we did. We found that shipping document, we found the invoice, we took it back to the financial statements for completeness. Okay, for existence, notice we could do, and here we're going to start from the financial statements and go back to the supporting documents. So we found the sales. We found the sale recorded in the sales journal. We went and found the invoice. We went and found the shipping document. So we went the other way for existence. Confirmation is a classic way to test the existence assertion. What happens? My client sits there and they say that somebody owes them money. So what do? I send a letter out to my client's customers saying, do you owe $10 million? So I'm starting from the financial statements. The subsidiary ledger said Burns owes 10 million. I send a letter to Burns, who's out there. I start at the financial statement, but I send the letter to Burns saying, hey, Burns, do you exist? Are you out there? Burns comes back and says, yes, I exist. And yes, I owe $10 million. I just prove the existence assertion because somebody, when I started with financial and somebody out there told me that they actually exist, they're actually out there. Okay. Now we look at valuation. Okay. Valuation, the best way to look at valuation is to recalculate. Recalculate is for valuation. Okay. Recalculate. So what happens? If Burns checks off that he owes $10 million, does that mean that the account receivable is properly stated? That it's valued correctly? I know Burns exists. Burns came back and said, yes, I owe 10 million, but do I know that that is properly valued?
No, we don't know if he's going to pay that full amount.
Burns could be broke, right? So what we're auditing really here when we deal with valuation is an estimate. Management's estimating the value, and they're going to, in this example, have to put what an amount in the allowance for doubtful accounts if for some reason they did an aging and it turns out that Burns has fallen behind on their payments. Now we're probably going to want to put some amount into the allowance in case Burns ends up not being able to pay. When I put an amount in the allowance, that's going to bring down the net value of the of the accounts receivable in this example. And so if that's the case, then I have just tested an estimate. Management really doesn't know for sure what they're going to collect. And so we would want to do a different procedure to help us with this different assertion valuation. So when you look at the set of financial statements, you look at them from a standpoint of assertions, and then you look at them from the standpoint of what audit procedures are going to help me to identify whether or not there's a misstatement in that assertion. Okay, so you consider those assertion level risks. Okay, what could go wrong at the assertion level? And that's going to ask you then, as I wrote it in that previous slide, or help you determine what is the potential misstatement. Okay, so again, back to my favorite slide, you would do what? You would obtain an understanding of the entity and its environment to do what? To help you assess the risk of material misstatement, meaning you're going to look at the inherent risk, you're going to look at the control risk, looking at control risk, you're going to consider, excuse me guys, you're going to consider the design and whether that control has been implemented. Based on the design and whether it's been implemented, you will make an assessment of risk and material misstatement. You make the assessment of risk and material misstatement at less than the maximum. You'll test the operating effectiveness of the controls. If you then, when you test the operating effectiveness of the controls, you then go to your substantive testing. If you assess the risk and material misstatement at the maximum, bypass the testing of operating effectiveness, follow the red arrow, go straight to your substantive testing. But when we're doing that by assertion. Okay, so hit my screen here. Okay, so when we're doing that by assertion. So what I have here is a little example that might be kind of hard to see on the screen, guys, but I'm going to read through to you what we're doing here. So bear with me. Maybe I can. Let me see if I put it in slideshow, if it maintains all my little. No, it doesn't. And so I don't like it as much. Well, it doesn't help that much. And I think we're better off if we actually can see all the things that I put on here. Not really, though. Actually, well, let's just look at it from here. Okay, because it doesn't make that much difference. Put your face a little closer to the screen so you can see this. Okay, so what happens? We have an account, say sales. Say we're auditing sales. And when you audit sales, which is an income statement account, you also want to think, is there another account that goes along with this that I can audit these two accounts simultaneously? Sales, assuming the sale is not a cash sale, accounts receivable might be an account that you can audit simultaneously with the sales. Okay, so you try to think of a related account. In this case, the related balance sheet account is going to be accounts receivable. Now, when I do my audit procedures, I do them by assertion, right? So I take the existence occurrence assertion, okay? And I look at the inherent risk. What is the potential misstatement, okay? And I write down here that the part that's highlighted as a potential misstatement is that a sale is recorded, but the goods are never shipped. Or another potential misstatement here is there's a return and they don't book the return. If they don't have something returned, then that sale didn't exist, okay? Now, I assessed my inherent risk, okay? And then I'm gonna look at my control risk, and I have to obtain an understanding of the controls. And when I obtain an understanding of the controls, I'm gonna look at the design and to see that it was implemented. So when you look under control technique, control procedure, control technique, these are synonymous terms. I just put control technique here. Individuals that complete sales order and submitted the sales order follow up with customers to confirm satisfaction of goods. So the same person that did the sale calls a couple days later and says, how do you like that brand new skateboard I sold you, whatever, right? Now, what happens? I have to assess the risk of material misstatement. And in this first tier of this thing, I say the risk of material misstatement is high. The control is not effective. I don't like the design of the control. It is not sufficient to allow for a lower assessment of control risk. There is no separation between the preparation of the sales order and the control technique. We look for separation of duties, okay? The same person that is responsible for the sales should not also be the person that follows up with the customer, because we're going to be able to use this control to determine if a sale is recorded where the goods actually weren't shipped. So I don't like the design of this control. And of course, I have to look in to see if it's implemented as well. And when I did a walkthrough, I say here, the staff didn't seem familiar with the procedure. When you do a walkthrough, remember, you're there that one day and you're looking to see if people understand how they're supposed to apply the procedures or if they're even applying them. And if in doing that, and I've done walkthroughs where halfway through the walkthrough, I'm telling them what they should be doing, okay? If that's the case, the person doesn't understand the procedure, that procedure is not implemented, okay? So I didn't like the design. I didn't see that it was implemented, so I assessed the risk of material misstatement at high, at the maximum. That being the case, I skipped the control testing. And notice, guys, I did all that first part, the IR and the CR part. I assessed my risk of material misstatement during the attaining the understanding phase. Now I'm in further audit procedures. I'm in my testing phase, but I'm going to bypass the testing of the controls here. I'm going to skip it because I don't think the controls are effective. I assess the risk of material misstatement at high, at the maximum. So I go over and look at my substantive column. I'm going to confirm. I'm going to pull some accounts receivable and I'm going to say, hey, did you owe this amount of money? So I confirm the receivable, but at the same time, I might also ask some key customers about particularly large sales. Did you have this sale, this purchase to my client's customer to do a purchase? Did you have this purchase on such and such a date? And I'll pull maybe a sample of transactions for that particular procedure. I may not ask every single customer. I'll probably stratify my sample by taking some large account receivables. Okay, but notice I did a bunch of substantive testing. Why? Because my risk of material misstatement was at the maximum. I had to lower my DR, my detection risk. How did I do that? By doing a lot of substantive procedures. Now you come to the second part of this down here, okay? And this is the same account, same assertion, but now we're going to change the same potential misstatement. The goods, they record a sale, but the goods are not shipped. There's a return, but they don't book the return. But now when I look at the control techniques, let's take a look. Sales manager follows up with customer on sales order prepared by staff to confirm satisfaction with goods, confirms goods and quantity shipped, and enters on a sales call log. The manager signs off on the call log. The call log is forwarded to the internal audit, and internal audit staff follows up monthly on a random sample of calls to reconfirm information entered on the call log. So now I'm looking, I've got a pretty good set of controls. I've got what the person who made the sale, but a sales manager follows up. And then I've got the internal audit staff who, remember, report directly to the board of directors, coming in behind and seeing that they're satisfied that that control is being implemented the way it's supposed to. So what happens? Low, the control is effective. Okay, I've assessed my risk of material misstatement. The control is effective. The manager follows up and signs off on the staff, further good separation of duty, and that we have the internal audit department following up. Internal audit department, we look to see that they report directly to the board of directors. We observed in walkthroughs that the staff seemed familiar, and then we observed calls being made by the internal audit staff, and we even participated in a couple of calls. Hey, the internal auditors are our auditing brethren, right? They understand what we're doing. Say, do you mind if I make the next call, so that you know there's not somebody in the other room saying, hey, is that idiot auditor still there? You actually talk to a customer, ask the questions about the quantities of the goods, et cetera, right? Further, we spoke to the board of directors, and they're aware of this process, and they're reading internal auditor reports to make sure that there's any problems, that they're following up on it, et cetera. So I'm looking, I've got a pretty good control environment. So what happens? Well, now I've assessed the risk of material misstatement at less than the maximum. So that means I have to test the operating effectiveness of the controls. So what do? I take those sales logs, and if I was going to pull a sample of 50 to look at, I would look at that one day I was there when I did my walkthrough. That helps me to assess the risk of material misstatement. But then I might pull 49 other days when I wasn't there to see that that has operating effectiveness, looking for the sign off on those call logs and see that they actually did that consistently throughout the year. Assuming that supports my lower cis level control risk. Now, notice my substantive column has shrunk. I do not have to do as much substantive testing, nature, extent, timing. Now I'm going to go ahead and just pull a sample of accounts receivable to confirm. And then, of course, I always will conduct some sort of year-end roll forward type testing. You just don't forget. If I did my testing in interim, I just don't forget the back end of the year, but it's going to be a much smaller amount of work. So again, this slide ties to what? To the other two slides in terms of talking about the wording that we use as we go through these different phases, with the idea that we do this work at the assertion level, and you have to line up the procedures with the assertions. And notice we look for controls that are helpful in preventing or detecting the misstatement and that assertion. So it's sort of like a sports fan, guys. So if we didn't have to use a sports analogy, but what happens if you've got a big guy coming in to tackle the quarterback? You don't send a little person to block that person, you send a big person, right? But if you've got a fast wide receiver that's going to go out and try to catch a pass, you don't put the big old guy to run next to him. You put another quick guy that can run next to that person to guard against whatever it is you're trying to defend against. So you match up the control with the assertion. So we just don't randomly throw controls at assertions. We find the assertion that is designed to prevent or detect the misstatement in that assertion. We look to see that it was implemented. We look at the design to see that it has an adequate design to prevent or detect the misstatement in the assertion. We look to see it was implemented, but then we test the operating effectiveness, and then we design the audit procedure, that's our DR now, to detect the misstatement in that assertion. Question? Okay, so again, guys, you line up, we already had this slide, and I'm going to go through every single assertion here. You line up the audit procedures with the assertions. Okay. Okay, good. Let's take a look at a couple of example questions here. Okay, and notice in this question, we are not calling out the account. Okay, we're just simply asking, do you know how to audit the, and you look and you're like, well, what assertion? Well, you need to develop some skill in understanding how wording is pointing to the assertion to you. So in determining whether transactions have been recorded, what assertion do you think that is?
Completion.
Completeness. Right, completeness, good. It's completeness, and you may be looking at it saying, well, because it's the answers in the original source document, right? I'm not hiding the answer from it here. But what, for the completeness assertion, we start with the source document, right? That invoice, the shipping document, and we do what? Try to take it back to make sure it was recorded in the financial statements. In other words, the financial statements are complete, right? Good. So you need to develop some skill that even if the assertion isn't explicitly called out to you, understand what assertion is being asked, and then be able to select the correct audit procedure that goes along with that assertion. Good. Question on that one? Okay, let's take a look at this one. You're auditing a store that sells merchandise. Some of the store merchandise is held on consignment. Okay, what is consignment? Let's say after taking accounting 310, you decide you're going to really go into auditing and stuff, and you're doing that so that your children don't have to become accountants. So you write a textbook, say mothers. You write a book, say mothers, don't let your children grow up to be accountants, right? And you try to take that book to Barnes and Noble, still in business. Okay, you go ahead and you take that book to Barnes and Noble and you say, hey, I want to be a writer. Would you please sell my book here? Barnes and Noble says, no. You say, please, I'll tell you what. Just take the book, put up a sign, cardboard figure of me. And if anyone buys the book, okay, you'll give me the money and I'll let you keep 1%. Well, in that situation, you are the co-signor, okay, is the author of that book. Barnes and Noble is the co-signee. Now, when the year end comes,
Those items do not belong to Barnes and Noble because you're just holding it there, hoping that somebody comes and buys it. Those goods are on consignment. Those books don't belong to Barnes and Noble. They belong to you. If there's a fire and the books burn, you would suffer the loss. Okay. And so what happens? The auditor, when they're looking at consignment, the account balance is rights and obligations. Even though Barnes and Noble has those books, the assertion is rights and obligation. Even though Barnes and Noble has those books in their store, they don't have the rights to that because what? They're just holding those there on behalf of you, the author, just in case there's a sale at some point in time in which they might keep a percentage, but they'll remit the rest of that back to you. Okay. Okay, good. What's the following procedure an auditor most likely perform to verify management's assertion of completeness? You can see the answer, but let's look at the bottom. Review standard bank confirmation. Confirmation is typically how we audit what? How we audit the existence assertion. Remember that one slide? Confirmation, take some information, send a letter out. So that's not going to help me with completeness. It might help me with existence. Confirm a sample of recorded receivable by direct communication. That's a fancy word of saying confirmation, right? I'm going to do what? I'm going to take a sample of transactions and send out a letter saying, hey, do you owe this money, right? Observe the entity's distribution of payroll checks. Well, that again is going to be the existence assertion. If they put down that they had to pay somebody, you're going to sit here and say, okay, you paid Andy 50 million for the year. Let's go see and find Andy and see that indeed, when we give him this check, there's actually somebody who might ask to see your ID or whatever, right? Okay. Compare a sample of shipping documents to the related invoices. This is the specific example we had here. We would find the shipping document, find the invoices, and then see that that's properly recorded in the financial statement. That's going to be the one that will help you with the completeness assertion. Okay. Okay, good. Now this one's a little tougher. Okay, this one kind of is going to test your accounting knowledge at the same time that it's going to get into your auditing understanding. Okay, so let's just take a look. Based on conversation with owner manager of an audit client, the auditor ascertained that a company's primary motivation is to avoid paying income taxes. Based on this motivation, what account balance assertion for ending inventory will the auditor be most concerned about verifying? So we're requiring you to think through what? A couple of different things. The balance sheet versus the income statement, the relationship between the balance sheet and the income statement, and how something on the balance sheet might affect what? Net income, because they're trying to avoid paying taxes here, right? So what are we going to worry about for the inventory? Well, you remember that beginning inventory plus purchases equals goods available for sale minus ending inventory equals cost of goods sold. Cost of goods sold is then going to be what? Subtracted from my sale to determine my gross profit. Lower the gross profit, obviously the lower the net income. So what happens? If I sit here and I understate my ending inventory, so I make my ending inventory less, then what's going to happen? That's going to have a smaller subtract from my goods available for sale, bringing up my cost of goods sold. If my cost of goods sold goes up, then my net income, my gross profit will come down, my net income will come down. Net income is down, less tax. So they've achieved the objective there by what? By understating, by not making their ending inventory complete. Understating it, they didn't include everything they should have. That made the inventory number too small. That drove up my cost of goods sold. Cost of goods sold goes up, gross profit comes down, net income comes down, taxes come down. Question? Okay, good. So what we're going to do is take a quick break and come back and finish up what chapter are we on here? Chapter 4. See what we can do with chapter 6. We'll think about chapter 6 here, and then maybe what I'm going to have to do is go through the exam in a recording and post that up, because I have a feeling we're going to run out of time and I'm not going to be able to go through that sample midterm 1 with you. So maybe what I'll do is record that separately and post that up for you. So anyway, let's go ahead. I want to take a quick break because I know you're probably busting at the seams here to take a break. So let's come back at, we'll make it 7:25, okay? And we'll definitely finish up chapter